Okay, everyone, good evening, or on the West Coast, good afternoon. Um, this is the second installment of Collab Capital's Let's Talk Numbers. If you came last week, we talked about Finance 101. The link to that video is on our LinkedIn page and I believe our Instagram page as well. But feel free to email any one of us to get the audio and copy of that. Today, we're going to be talking about cash flow and revenue recognition, primarily cash flow, and we may hop into revenue recognition at the end. But being that for startups, so much of the battle is managing your cash, I thought it was important to bring this to the forefront also because oftentimes cash flow may be the last thing that you sort of learn in a finance discipline or accounting discipline or as an operator. And so although I don't want to get into the boring details, I do want to give everyone the ability to understand what cash flow is. In terms of objectives today, the first objective is, let me start with the middle. This one I kept from last week. I think too often as Black people, as Black founders, we have this particular struggle with finance and it hinders our business. And so Jewel and I, when we sort of thought about this, that was probably the guiding light around why we wanted to do it. And then much of finance is just understanding patterns. Of course, there's some math to it, but a lot of it is just understanding the names for certain things and understanding how to use them as much as sort of being some sort of accountant or anything of that nature. The other two objectives today, you cannot spend profit. So we spend a lot of time talking about profit, but you cannot go to the bank and spend it. So it's easier to calculate, and that's why most people stop there. But what actually ends up in your bank account is cash flow. And if you end your analysis at profit, you put yourself at risk of growing right into insolvency, which is something a lot of people will talk about when they talk about growing a business, starting a business. You can actually be growing and run out of cash. And that's terrible if you don't understand how to handle it. And actually something that you can manage pretty easily if you understand it. There's plenty of solutions for that. You can also get in trouble with investors and employees not managing it correctly. So making payroll or thinking you have 3 months to raise capital and you really have 30 days. On the right side, the third objective is just cash flow is oxygen for startups. So when you run out of cash, it means you run out of business. They kind of coincide. And so once the cash is gone, you can't take it back to the bank. So you have to make choices ahead of time to manage it. Once it's sort of out the door, it's out the door. And then creatively, if you're able to manage your cash flow, you can extend your runway or how long you can be in business by 6 or 12 months. And so that's why it matters. Today on our agenda, we're going to go through a week one recap. Then I'm going to introduce my amazing co-host today, Rachel Wilson, who you probably see on camera. Then we're going to talk through what is the difference between profit and cash flow? Why do I always hear about profit and not cash flow? Why is cash flow so important? How do you calculate it easily? And then if you want more details, how can you practice more? So week one recap. What we went through last week was Finance 101, how founders use finance. We went through the income statement, the balance sheet, and the cash flow statement. For the whole world, they run on 3-statement financials, and so those are the 3 statements, which is why we covered them. We talked about runway and burn rate, particularly as it pertains to how long a business has to operate, given how much they're burning in a given month. That's what actually led us to the cash flow conversation. And then we talked about how it helps founders make decisions. So if those are things you want to learn more about, please reach out to us to get the tape from last week, or you can find the tape linked in our social. So now I want to introduce my co-host, Rachel Wilson, Principal and Head of Operations at Collab Capital. I work for Rachel, and today she will be playing the role of the founder, making sure that we balance details with sort of making sure everybody understands. Rachel, welcome.
Hi, everyone, and thank you, Elliott, for allowing me to help you out today. I will be your Black Vanna White.
There we go. So we'll try to have some fun with this today. All right. So when we think about the difference in between profit and cash flow, as a founder, you may ask the question, what is the difference? And what I'll tell you is that the key difference between cash flow and profit is that while profit indicates the amount of money left over after all expenses has been paid, cash flow indicates the net cash flow into and out of a business. Profit and cash flow are both important, and this came out of a Harvard Business School pamphlet on understanding finance for business managers. But one of the things that's very important to understand is that profit is not cash flow is not profit, and you can have a profitable business that has negative cash flow and a positive cash flow positive business that is not profitable. And so I think to understand those, let's go through two examples. The first one being an example of a profitable business with negative cash flow. So imagine a e-commerce business that get paid 2 weeks after a sale occurs, but pays its employees and buys inventory weekly. So they're getting cash in every 2 weeks, but they're putting cash out every week. On their income statement, they would likely be profitable, but because they're putting money out quicker than they're getting it in, it's likely that they'll be cash flow negative. And so that may be a situation that some of you find yourselves in. And that's just something you have to manage as a startup founder. Another example of a different example of being cash flow positive, but not profitable. So imagine a software as a service business that gets paid once a year or a year in advance, but currently has more expenses than revenue. It's in startup phase. So imagine you're just kicking off a SaaS business. You might have one customer, gets paid at the beginning of the year. So you're cash flow positive, they paid you for the whole year, but you're on a monthly basis, you're spending money to hire people, to design, to all these things. So you're not profitable, but you can be cash flow positive. And so those are just two examples as we start this off. So
question for you, Elliott. So I'm just putting on my founder hat. When I think about profit and think more so just on the profit side, I tend to calculate what the cost of my product or service is and what I charge for that. So is that not the way I should be thinking about profit?
You should not change the way that you're thinking about profit. The thing is to understand that profit is not cash flow. So the biggest difference in between profit and cash flow is the difference in when you pay people versus when you get paid. So for a lot of businesses, they're almost the same thing because most businesses or a lot of businesses are using credit card swipes. And so people are getting paid right away. But some businesses, you may not get paid for 30 days, for 60 days, for 90 days. In that case, you would have sold $1 million worth of business. You might have $800,000 worth of costs. But if you don't get the $1 million for 3 months, you have to understand the cash flow to be able to manage your business. Is that helpful?
Yes. And so what I have in the bank and what I'm actually and how I'm spending it really matters a lot. Is that what you're saying, essentially?
Very much so. And so the analysis to get to that number and that sort of understanding of your business takes a bit more. It's not incredibly more difficult, but it does force you to think about more than just revenue minus expenses.
Thank you. So question for you on this one. Why do I always hear about profit, but I don't always necessarily hear about cash flow?
Great question. So the reason you hear about profit is that most financial analysis is done on big public companies. And because they're in steady state and not in startup mode, way more time is spent and a bigger piece of understanding them is on profit and not cash flow. They've sort of gone through the startup phase already, and so it's not as big of a deal. Second, let's be honest, profit is easier to calculate and understand than cash flow. And so sort of most people's first stop on any kind of financial understanding is going to be profit. Cash flow comes after. And then third, cash flow is arguably most important to the entrepreneur, but the entrepreneur often has the least amount of help and fewest number of classes, lessons on what is necessary. So because for us as Collab as venture capitalists, and for most of the people listening that are probably in a startup context, there's just fewer resources for this phase of business than for the later phase of business that is most often taught in business schools and colleges, et cetera.
So should I be talking about cash flow more often too when it comes to my business and not only talking about profit?
Yes. I encourage everyone to think about cash flow as oxygen. And so runway becomes almost like having air in a cell. And so once you run out of air, you're out of business. And so as much as we talk about profit, and I encourage you to continue to do that, I would encourage you to talk about cash flow almost as much, or at least in your business, understand the difference in between profit and cash flow in a given month or a quarter or a year, just so you understand how close your profit number is to cash flow. If it's very close, meaning you get paid almost right away and you're paying people right away, then it's not as important. If you have delays in when you get paid or when you pay certain people, so some people may pay vendors up front or 30-day lag, that's when you need to understand and talk about cash flow more. Also, I didn't say this, but everyone should feel comfortable dropping questions into the chat in real time. We will try our best to address those in a Q&A portion later on. We wanted to make this interactive. So Rachel is playing the founder, but a lot of people on the line are founders. So don't let that discourage you from asking questions. We'll try our best to answer the questions during the presentation, and the ones that we don't get to, we will then answer at the end. So another question, go ahead, Rachel.
No, I was just gonna ask, so why is it important? Why is cash flow so important? Do you think, especially to VCs and other people I might be thinking about talking to my business about?
Sure, great question. And this is one Rachel encouraged me to spend more time on when we prepared. So when you're financing a startup, which a lot of people are doing, most startups don't have profit out of the gate. And so you have to do things like bootstrap. So you work job A to give you cash flow to start business B, right? Or you get money from family and friends. And oftentimes that money is not the kind of money that's going to last you years. It's going to last you months. And so understanding cash flow is very important so you can understand how much job A needs to make you to be able to fund your business, or to know if I get $50,000 from friends and family, how long can I go? Similar to that, but a bit different, raising capital and how much. So oftentimes one of the big questions around friends and family rounds or seed rounds is, how much do I need to raise? And to understand that, you need to understand cash flow way more than you need to understand profit. How long will $10,000, $100,000 last you, so you can sort of make sure you're raising enough? The other piece, number 3, is understanding if you can afford certain business choices. So at the beginning of a business, you have choices like hiring. So the question becomes, can I afford to hire this person right now? Well, if you have $10,000 worth of cash left and that person's going to cost $10,000 in a month, making the choice to hire them takes your runway down to, a couple of days. So that may not be a choice you can fiscally make. Sales cycle. So a lot of founders will talk about the sales cycle may be long to sell into major corporations or to certain type of companies. And so if your sales cycle for those places is 9 months long, as a startup founder, you may need to find more creative ways to sell smaller pieces to other folks sooner because having to finance 9 months of business operation on a variable outcome sell or don't sell is very tough at the beginning of a business. So again, choices that you may have in a business. The third one I'll talk about is inventory. So if you need an expensive unit, so maybe you're selling some sort of product, and if that product costs $10,000, well then $100,000 only gets you 10 units of inventory, or 5 units of inventory and $50,000 to fund your business. So again, choices you're gonna have to make. Or a lot of people get into situations where they're able to sell their product into big retail, so Target or Walmart. Well, if you have to fill 150 stores worth of inventory and you have a limited amount of cash, you still have to start thinking about what can you deliver without raising capital and what can you not. So they all impact decisions that you'll make. I see a question in the chat.
There's a question in the chat.
When it comes to cash flow, how would one go about projecting when they are in the test market launch phase? Should we wait 30, 45, 60, 90 days after launching an app and have hard data before we start cash flow projection? Or could we gather data on the industry as a general rule of thumb and possibly lowball that number in their projections? Great question, Bronson. We're gonna get into that here shortly. I think the answer is, as soon as you can, you wanna start projecting cash flow. That doesn't mean you need to go spend 3 weeks creating some fancy model. So part of what we're gonna talk about today are some quick hacks to get that information in your hands quicker, but we will talk about how to calculate it. I would encourage you to do it early on, but I would highly encourage you to do it before you speak to investors. Maybe not friends and family, it's an easier sort of round, particularly when you're talking to seed investors or VCs, you wanna sort of understand your cash flow. Thank you for the question. And if we don't get to it later, Bronson, please speak up.
And that was a great question, Bronson, because that was exactly what I was going to ask. How often should I be calculating this?
Sure. So the answer to that varies. And it's interesting because arguably when you have a lot of cash, you may not need to calculate as much as when you get short on cash. When one bad decision could put you out of business, you may need to think about it more. I'm also going to talk about this in a couple of slides. Don't think that you're on your own. So a lot of people who are starting up a business, at least on an annual basis, are having an accountant do your taxes. Well, that's a great chance to have somebody help you with cash flow. A lot of you are using financial softwares. Those softwares can export cash flow. And so there's some quick ways to get it. I would encourage the average startup founder to at least be looking at cash flow quarterly, if not monthly, is sort of my recommendation. Other people may have different ones. And again, it also depends on how different your profit number is from your cash flow. If your profit number and your cash flow number are highly different, like we talked about, an e-commerce business has to buy inventory, or other businesses that get paid or pay people with delays, those folks would need to do it a bit more often. So Bronson preempted a pretty good question. So let's talk about some ways to find cash flow quickly. So one of them I already talked about. So if you use QuickBooks or FreshBooks or a lot of the softwares for handling finance, your financials, you can export your cash flow statement. And I'm gonna walk you through what's in it in a second. I did a very quick piece of it in week 1, but I'll go to a deeper dive here shortly. Ask your accountant or business advisor. So your accountant does your taxes, or maybe you have an accountant friend. Most of us have someone out there that knows some accounting. Ask them to help you understand your cash flow, or help you calculate it, or at least understand what are the major differences in between your profit and your cash flow. And then third, and this is something I would encourage you to do before speaking to a venture capitalist, and we're gonna go into a deep dive on this in either a week or two, around what you should do before you go talk to your VC as it pertains to finance. But I would encourage you to look at systems like Xero that is sort of a SaaS business that helps people with their financials. And so if it's something that you don't want to do, this isn't your forte, you're a programmer and getting in Excel to do this is not your thing, look at places like Xero. Maybe go find a fractional CFO or someone on Upwork. Oftentimes doing it once when you first do your projection will give you sort of a rubric for how to do it going forward. And then you can look at fractional CFOs. A lot of them hang out in and around the startup community because a lot of VCs and seed investors like having the financials put into a certain format. And so again, if this is not your forte, there's a couple of ways you can get to it quickly or through things you're already doing.
We do have a question too in the Q&A, Elliott.
Thank you.
How do you determine how long of a runway your company needs, or at what point should the cash be reinvested?
So generally, when we talk about runway, it's your sort of monthly burn rate divided into how much cash you have. So if you have $100,000 worth of cash and you spend $25,000 a month, then your runway is 4 months plus or minus. And so that's the simple math. In terms of sort of at what point the cash should be reinvested, I'm not exactly sure what you're speaking about there, but I will say in general, founders always have the choice of another month of operation or paying a fractional person like a salesperson to help, or paying for a service or something of that nature. So we're always managing the decisions around cash. And that's why if you know you spend $25,000 a month now and you have $100,000, if you make the same choices, you have 4 months. If you spend more, you have less time. And if you spend less, you have more. So a lot of founders will cut down their expenses substantially when they realize they're within a couple of months of running out of cash.
So I would also say another good way of asking this question too, maybe, Elliott, is I know what my fixed expenses are and I know what I have coming in, but I want to make sure that I'm paying those expenses, and I want to make sure that I'm also reinvesting back into whatever my product or service is. How do I make sure that I'm calculating my cash flow correctly? And also being able to, reinvest or put, more money back into the product or services.
Great question. So when I say how much money you spend in a month, some of it is going to be this $25,000 I've used in this example. That's going to include money that you're spending on reinvesting in the business. So say you're building a software business. Part of that $25,000 or part of your monthly burn would be to go to employees who are doing marketing, that are selling, that are doing administrative tasks, et cetera. But some of that money is going to be spent on developers and coders who are directly impacting the quality of the product. And so you'd be investing or reinvesting some of that money back into the business. And other businesses. So we have a couple of businesses in our portfolio that have a sort of an e-commerce component. So some of their spend on a monthly basis is for keeping the lights on, shipping the product out, making sure that everything is bundled correctly. But also some of it is making promotional materials that are going to be promotional materials you may make in this month, like a video commercial or an ad that might not air until next month and might not bring in cash until the third month. And so there's always a give and take. To answer your question the best way I can, when you have a lot of cash, you have some more free range to invest more in the future, because the future is going to happen before you run out of cash. When you get shorter on cash, the reason why it gets more difficult is because you may have to consider investments that make great long-term sense for your business, but the benefit of those things may accrue after you run out of cash. And so you have to really optimize for things that will get cash now. So for instance, in the software example I used earlier, you may have a software that you're reinvesting in. All of a sudden, if you get tight on cash for whatever reason, you may need to amp up what you're paying for sales and digital ads and promotions, because you need to get that product out the door to sell it, to bring in revenue. And you may have to pull back or maybe furlough people who are working on the development of new features because you really need the cash in the door.
That was really helpful. We have another question from Bronson, but I think you might be able to answer that on the next following slide.
Okay, well, let me go to the next slide and then pop open the question again. Okay, so next I'm gonna hop into a example model. In fact, the same example model I talked through last week to try to keep the consistency and sort of get us into the same model repeatedly. It's not an overly complex one. And part of getting over the stigma, I think, is just pushing yourself to actually ingest the information. Your question, Bronson, around you've done projections 1 million times, a Black founder with no technical background coming from oil and gas industry to tech, find the numbers astronomical, but still makes sense in terms of the industry. What's the rule of thumb on a ratio between getting funded on companies with zero projection to companies with actual revenue? Basically, the likelihood of gaining small seed funding with no hard data, but have an actual app in hand with sample projections, including total addressable market. So that is an amazing question that is a bit hard to answer definitively. And being an oil and gas person, you can probably understand, just like the oil and gas price is hard to predict. Some of these things are tough to kind of nail down. Us as venture capitalists, we understand that we're going to have to invest in things before everything is all the way buttoned up. So keep in mind that anyone that's sitting in the seat of a seed investor, like we said, or a venture capitalist, we kind of sit in both seats. Understand that you're not going to have everything buttoned up when you come to us, right? So your projection versus not, having an example product versus not, understanding your total addressable market versus not. All those things, I would almost consider them on a sliding scale. And so the more you understand about your business, the easier it is for an investor to evaluate and say yes to. That's really why you want to do it. It takes less work for us to say yes when you have some of the important pieces put together. That does not mean if you slide the scale back and you haven't done as many things, or might not have a product, or might still be figuring out your total addressable market. It doesn't mean that venture capitalists or seed investors won't invest. It might just take a little bit more time or a little bit more work for us to evaluate the opportunity to then make a decision. And given how everyone is managing their portfolio of time, that's why if you have the opportunity and you can do some of these things, it's highly encouraged that you do. Your final question, which I'm assuming is the most important, the likelihood of gaining small seed funding with no hard data, but have an actual app in hand with sample projections, including TAM. I mean, if you're there, you're on the precipice, right? You're right before the point where you should be able to get some data. And there are an endless amount of investors that invest at that stage. So your likelihood is high. Need to find the right investor, and then also be sure to keep continuing to run your business as if you weren't getting investments while you're seeking it. Okay, so now I want to get an example of how the cash flow statement works. So I'm going to pull up the same model that we looked at last week, and let me see if I can move this over here. So I'm going to start with the income statement again, because I think it grounds everyone in where we are. And this is a model for Dollar Cave Club, not to be mixed up with Dollar Shave Club. So a monthly subscription business. If we look at the income statement, this company is starting off and call it year one with $300,000 of revenue, ramping up to $4 million of revenue. What's important to see here is that their EBITDA or profit is negative for 1, 2, 3, 4 years before they turn a profit in year 5. So how does this business look from a cash perspective? So let's go to the balance sheet, which is where you see cash. This business started off with $300,000 of cash, and you'll see they ramped up to 2 million this year and kind of ramped down to 1.5 in the end. So you can tell there's some movement in cash here that we're trying to understand. So now this is why the cash flow statement makes such a big difference and why you should understand it. I'll also tell you that there's 2 ways to calculate the cash flow. The first one is the indirect method, which I'm going to hop into first. The second is the direct method, and you'll understand why I get into that second. So how do you calculate cash flow? So in most cash flow statements, particularly when they're calculated, you're going to see the beginning cash balance at the top. The reason being is that you want to understand where you start, because after you calculate it at the end of the year or the month, where you end is going to be a different number, and they show up in different places on the balance sheet. So the way that you do the indirect method of calculating cash flow is you start with net income. Net income is simply your sales, all your sales minus all your expenses. So it's typically at the bottom or near the bottom of your income statement. And so if you notice, the EBITDA number that we had here in year 1 shows up again as the net income, because it's essentially the same without interest, tax, depreciation, and amortization. So it shows up here. So you start with the net income to begin the calculation. Now you go through a series of operating adjustments. What are operating adjustments? Those are things that we talked about in terms of times when people pay you in a delayed situation and when you pay people in a delayed situation. So I'm not going to spend a lot of time into each category, but one of the things you're going to account for is the change in accounts receivable. Accounts receivable are essentially IOUs. I ship a product to Rachel, and Rachel pays me in 30 days. Rachel owes me the value of one product. The amount that she owes me will show up in accounts receivable, and it's just the way you account for that delay. Alternatively, if John worked for me and I paid John once a month, so on day 1, I would owe him a portion. 3 weeks in, I would owe him a portion. What I owe John or what I owe my vendors will show up in accounts payable. So you go and you adjust for those things. Again, part of what I'm doing here is showing you how to calculate it. If you want to get into a double click on any one of these things, this is where you might want to bring in some of the help I talked about on a couple of slides ago. Now that you've adjusted for accounts receivable, AR, accounts payable, AP, you would also adjust for amortization and depreciation. For those of you that know, those are non-cash expenses. They're tax constructs, so you don't pay anybody depreciation. Depreciation is expense you're able to put through your income statement to positively impact your taxes. So you would adjust it out here because it's a non-cash item. Change in inventory value. So if you purchase inventory, you need to account for that change in the operating adjustments. And then once you do all of that, you would get to your total operating adjustments. So in this case, negative $6,500 in year 1 is just the sum of these 4 areas. 1 has a 0 in it. And so your business may have different adjustments for these things. Again, people may pay you as soon as they buy things with a credit card, so that would go to 0. You may pay people every week, so you don't have a huge delay in accounts payable. That's actually to your benefit. It means you don't have to worry about these things as much. But now if you're an e-commerce business and you're purchasing inventory, then you need to focus more on the inventory adjustment when you think about operating adjustments. And so now I'll stop for a second, because the first part of the cash flow statement is the operating cash flow. And the operating cash flow is the net income after you adjust for the operating adjustments. And the reason that's important to know is, and it'll make more sense when we get to the bottom, you want to understand in what portions of your business your cash is coming in or out. So if you notice, with these three things, more cash is going out than in. And so from an operating perspective, you're losing money at net income and you're spending a bit of money on adjustments. So you know from your operations perspective in this period, you are in need of cash. This will make more sense as we come down. So,
quick question, Elliott, before you move past that part. So these are all on an annual basis. Should I be doing this on a monthly? And if I'm doing it on a monthly, am I considering things that I'm paying days out or on a month-to-month basis? And I know sometimes some businesses call this accrual basis or cash basis. So can you help me a little bit about that?
Absolutely. So even in this example model, I'm showing you the annual because it's easier to show the progression from negative profit to positive. There's also a monthly cash flow statement that's a bit further back that I'm not hopping into just because it's harder to show those changes. But as you can see, this particular model is looking at cash flow on a monthly basis. You asked about a daily basis. If I'm within 30 days of running out of cash, then I need to understand this on a daily basis. If I'm not, then probably a monthly basis is more reasonable. And if you're just getting started, you should start with the annual basis just because it gives you a grounding. There were several times in the presentation where I mentioned if your profit or your EBITDA is very similar to your cash flow after you calculate it, then you have to worry about cash flow less. And you'll know that once you do the annual analysis, which is easier, and then you don't have to worry about it as much. If your cash flow varies significantly from your profit, this is where you may need to do it in a more granular way. Your second question was one of the more fun ones. So accrual versus cash. So we talked about profit, you can't spend it. Cash, you can. So the cash flow statement actually reconciles cash basis accounting to accrual. So generally, and if I had more time, I could get into the specifics, but I might put some people to sleep, so I won't. The income statement is generally going to be presented in accrual basis if that's the way you are creating it. There are also sometimes when your income statement can be presented in a cash basis. And honestly, for a lot of small and medium businesses, it's either done on a cash basis or a quasi-cash basis when you first get started because it's easier. More sophisticated businesses or businesses that have a rationale for doing it on an accrual basis, they also occur in the startup arena, which the way that you know is when you have things like accounts receivable, so IOUs, and accounts payable on the balance sheet. Those are indicative of an accrual basis financial presentation. When you see a cash basis, what you would see is the income statement will look similar, but there would be no accounts receivable and no accounts payable because those things are represented when they go in and out. So let me take another step back. What is cash basis? What is accrual? Cash basis is as if you just looked at your bank statement each month. So it's cash in is represented in the period it comes in, cash out is represented in the period that it comes out. No adjustments. It's almost like your bank statement, right? You're not accounting for the fact that somebody's paying you this month for something that you did 3 months ago. If it came in this month, you mark it as revenue this month. So what the heck is accrual? And why would we even deal with this craziness? Accrual is helpful for that reason. When people are paying you today for work you did 3 months ago, the way that the whole world looks at financials generally, and almost every public company will present this way, is you want to match your revenues and your expenses in the same period so you can analyze properly what happened in this month. So if you want to look at April, you want to know what work did you do in April and what revenue did that work create. And so that's why you have things like accounts receivable and accounts payable, because although I did the work, I paid people for the work in April, they don't pay me till May. But if I look at that in May, let's say you're growing. So you look at that and your revenue is increasing in May, but you reduce how much work you do. You might incorrectly think that May is a better month when really May looks better because of April. So the whole reason we have this crazy construct of accrual is just to match revenues and expenses so that when you're analyzing your financials, you're more likely to make wise business decisions. Again, most people who are starting a company are not an accounting major. So if this stuff is difficult for you, I'm not encouraging you to, on top of your business, go learn accounting. I'm encouraging you to get some help. And there's some low-cost ways that I mentioned in the presentation. And I'm going to do a whole presentation on low-cost ways to get this stuff in order. It's important enough for you to know, but it doesn't cost a whole lot to get it in order using help. Does that help, Rachel?
That helps a lot, especially because sometimes we think what we got coming in, we're not necessarily always thinking about, when we'll get paid again, or if there's a debt that we owe, like our credit cards.
Right.
And we're like, I'm not going to pay that until 60 days out because I need this cash.
Right.
So just making sure that you're always thinking about how you're actually spending and what you actually have coming in.
Which is a great example. Additionally, for a lot of bootstrapping entrepreneurs, you're going to try to extend your payables as long as you can through things like credit cards, loans to friends, and that kind of thing. And you don't want to get caught up in you taking on all this debt, and you have a great product, great business, but you're taking on so much debt, you can't get out of it. And so that's the other reason why it's important to understand cash flow, which actually is a great introduction to the next section, or the next two sections of the cash flow statement in the indirect method. So after you get done with the operating adjustments, the next piece are the investing cash flows. And for most of the businesses in technology, you're not going to have huge investing cash flows, which are typically capital expenditures and sort of permutations of that. However, if you were to spend $500,000 in year one further developing your software product, that would be an investment from a capital expenditure perspective that would go here, right? And so if there were investing cash flows, they'd be calculated in this next portion of the cash flow statement. There aren't, so right now there's zero. But if you were looking at a business that was operating at negative profit from an operating perspective, and then again, investing more money through investing cash flows, now you understand why the third portion of this statement is so important, which is financing cash flows. And so this is where the investments in startups will show up on your cash flow statement. So this is how a company that's losing $833,000 at the EBITDA level and $840 at the operating cash flow level can operate. It's because they're taking on financing cash flows. So financing cash flows are all equity infusions, all debt financings. And for a lot of startup companies, they're doing convertible notes, safes, and our investment instrument is called a SPACE, a share profit and collaborative endorsement agreement. So those dollar amounts go here. So this business took on $1 million in year one, $2.5 million in equity financing in year two. And so those cash flows come here. So that now when you think about the total cash flow in year one, there was a negative $840,000 through operating, no impact to investing, $1 million in financing cash flows to net out for a positive $159,000. So they fueled their operation with equity financing in year one. Year two, you had negative another $1 million. They took on $2.5 million. And so you're operating at a positive cash flow of 1.58. And so this business probably did a projection to realize that I'm going to need a bit more than just this year's cash flow in an investment. So they took on a bigger investment in year two than they did in year one. And so now in year three, they lost $770,000. So now that subtracts from this to get their ending cash balance. And then by the time that they go to year five, they're operating at a positive net income. And now they don't need additional investment. So the three segments of the cash flow are operating cash flow. That's the business operation. How much cash does it create or use? Investing cash flow. how much money is invested, reinvested in the business. Or sometimes you might sell an asset. So one of the companies in the Collab portfolio rents cars. And so they'll buy a car, use it for a while and sell it. If you were to sell a car, that cash would be a negative capital expenditure essentially. And so you understand how assets are bought, invested in, and sold in this portion of the cash flow statement. And then financing cash flows are all your equity and debt-like investments. And so now you can understand for a startup, this is kind of how long you can function in a negative profit arena before going out of business. So that was a very short description of a cash flow statement. Now you might look at 10 of these, 100 of these. They may look different in sort of what items are here in investing, in operating, and financing. But if you use the indirect method, which is how most people are going to calculate their cash flow, you're going to see the same operating cash flow, investing, and financing. Now, I mentioned there were two ways to create the cash flow statement. This one is typically used if you're trying to project it out, right? But the other way is the direct method. And I'm not going to spend nearly as much time on the direct method, but the direct method is realizing that your cash flow statement is just almost like your bank statement. It's just cash in, cash out. And so if you export your cash flow statement from QuickBooks, or if you have your accountant export your cash flow statement, it's going to look more like this direct method. Because what QuickBooks is doing is just showing you all the cash in, all the cash out, and they don't have to do it in that sort of formulaic way. They just do it directly. If you look at a public company's cash flow statement, it'll look like this as well. So again, because most of you are going to be working with projections and not exports from QuickBooks, but although I want to account for both, the way this looks is, again, your beginning cash balance at the top. You have your cash receipts, your change in AR, your total receipts, disbursements, so your expenses, AP, inventory, and then there's an expanded portion that they call net cash from operations. So really they're just netting all of the things that were in our operating and investing cash flows in the net cash flow from operations. And then at the bottom, they go through equity and debt investments here. And so if you look at this, the total cash flows here are the same as they are in the indirect method, just calculated differently. And so again, if you're projecting it, you're probably going to use the indirect method. If you export it from QuickBooks and want to kind of see how different your cash flow is from your profit, it will look more like this. And I'm showing you both not to confuse you, but I'm showing you both to recognize whether you see it in the indirect method or the direct method, the answer is the same. It's just different in how it was created and where it came from. So I see a raised hand. Jay, great question. So are investors interested in that level of detail? Not really. This is more for the founders, which is why I brought Rachel on to represent the founders. This is for you to understand how much cash you're going to need to operate your business for the time period you're going to need to start showing positive metrics, trends, whatever. And also to allow you to understand how much cash you need to have to fund that time to get to positive metrics. And again, I talked about that sliding scale of sort of, you might not have done some of these things to you've done a lot of these things. There's no perfect sort of mix of that. It changes. But if you're trying to say, hey, I want to build a software business that's going to need, $75,000 of investment to get up off the ground, another 4 to 6 months to sell it, and I'm not going to have positive metrics for about a year, and I know I'm going to need to quit my job full time to do this, and I need to at least have $5,000 a month to make it happen. I'm going to need to pay some external programmer, $30,000 to do this portion, and then the other 45 later. For you to understand how much cash you need and how much cash you're spending, this is why this analysis is important for founders. Now, as venture capitalists, we're going to look at it too more from you may say, hey, no, this is a small investment. I don't need $500,000, Elliot. I just need $200,000. I'm fine. And we might look at this and say, there's no way you're going to spend $200,000 on software development. And so you'll be out of cash. And so part of the reason why we actually increased the amount of money we initially invest in companies was because we realized that a lot of founders were needing more cash than we initially thought. So this is really for the entrepreneurs in the world to understand your cash position. Again, the reason being, once you run out of cash, you're out of business, right? And so you can't call a venture capitalist on the day you're out of cash and say, hey, I need some help today. So even to manage when you need to have conversations with investors, also, you're going to get the absolute worst terms if you show up like, I need cash to pay payroll tomorrow. You're going to get a lot worse terms than if you know that you're going to be out of cash in 2 months. And even though the business may not have better metrics, because you know that, you can be having smart conversations earlier. The reality for startup founders, and I'm an entrepreneur myself, is that you're always balancing where you spend your time. So if you have a rich uncle or you have a trust fund, this might not be as important for you. If you're bootstrapping like a lot of us Black founders and robbing Peter to pay Paul and hoping your auntie and your grandma give you $10,000, it's more important to understand how slowly you can or how long you can manage your business with a slow drip of expenses, or knowing that, hey, I need to overspend month one because without a software concept, I'm not going to even be able to show anyone. And so either way, knowing that will allow you to understand what you need.
There is a Q&A.
Okay. What is the rule of thumb to start looking for an additional equity investment after you acquire seed funding? And how do you calculate how much more you may need? Let me answer your second question first. So the way that you would calculate how much more you need, you would do this monthly analysis on a cash flow basis that we talked about, or you would get sort of your current cash flow statement printed out of QuickBooks and sort of continue that forward so you kind of knew how much cash was coming out. And what you generally want to do with understanding how much cash you need is think about, you want to get to a new milestone or set of milestones before you need to raise money again. So you want to have 2 out of your 5 things accomplished to get seed, for instance, and now you may want 2 more to get Series A. And so if you need another year to get to those other 2 milestones, they typically say raise at least 1.5 times that, or if you can, 2 times that. And so you're going to model how much you think you need given your reasonable assumptions, and then try to get a cushion. And that's how much you're going to want to ask for with your beginning ask. Like I said, most investors are going to be very thoughtful about how much money they believe you're going to need to be successful too. So you won't be the only one looking at this, but when you put together your pitch decks, that's the number you want to put at the end. And then the first part of your question was rule of thumb to start looking for additional equity investment after you acquire seed funding. I think as a founder, you're always fundraising. That doesn't mean you're spending 40% of your time fundraising, but I think if you've acquired seed funding, depending on what your runway is, if a fundraising process is going to take 3 to 6 months, you absolutely need to give yourself that much time. But the best investors are people that already know you, that have experienced who you are, that you get warm introductions to, that you've been able to speak to a couple of times before they need to make or consider an investment. And so, you know, if you were my best friend, the way I would answer that is you always want to be spending some portion of your time fundraising. And then when you get into that 3 to 6 months before you're going to run out of cash, that's when you really want to sort of ramp it up, which is unfortunate because you have to balance business operation and fundraising. But that's the life of a startup founder. And honestly, that's a big piece of why Collab was created, to sort of help people through this process and to be a solution from a cash perspective for companies that we like and think should fit in our portfolio. I am running down to the end of our time. So I want to say I have time for one more question, if we have one from the audience. If not, then I'll sort of end this and talk through what we're doing next.
I don't see any.
Okay. All right. Well, that's fine. This was helpful. So this was a bit denser material than before. So the reason I brought Rachel on was to hopefully get through this in a way that kind of had a yin and yang component, and hopefully that was better and enjoyable for you guys. As we're building out this sort of 4-part analysis, part 1 was Finance 101. This was cash flow, because cash flow is oxygen for a startup founder. And next, we're going to talk about building out your projections. So a lot of the questions were, how do I build those out? What do those look like? And other topics. So we're going to cover that next week. So please join us next Monday for that. And we thank you for coming. Same time, 5 p.m. Eastern on Zoom as well. And given that, thank you everyone for your time. And hopefully we see you next week. I see a couple of questions here that have popped up. Thank you. Next one. Okay. Those are mainly thank yous. Thanks, everyone. I'll see you next week.